The stock market moves every single second, and every small movement tells a story. Behind every green or red number on a trading screen, there are millions of decisions being made by investors, traders, institutions, and companies around the world. Some people are buying, some are selling, and others are simply watching the market closely to understand what might happen next. When traders open a trading platform, the first thing they usually look at is the chart. Charts are one of the most important tools in the stock market because they visually show how a stock price is moving over time. Instead of looking at numbers alone, charts help traders understand patterns, trends, and possible opportunities. One of the most popular types of charts used in trading is the candlestick chart. Candlestick charts are widely used by traders because they provide detailed information about price movement within a specific period of time. Each candle represents a specific time frame. That time frame can be 1 minute, 5 minutes, 1 hour, 1 day, or even 1 week. Within that single candle, the chart shows 4 important pieces of information: the opening price, the closing price, the highest price, and the lowest price during that time period. If the closing price is higher than the opening price, the candle is usually shown in green. A green candle indicates that the price moved upward during that period. On the other hand, if the closing price is lower than the opening price, the candle is usually shown in red. A red candle indicates that the price moved downward. By looking at these candles, traders try to understand the behavior of the market. For example, if several green candles appear in a row, it may suggest that buyers are currently stronger than sellers. If several red candles appear consecutively, it may indicate that sellers are dominating the market. However, trading is not only about looking at a few candles. Traders usually analyze entire patterns that appear on charts. These patterns can sometimes provide clues about what might happen next. Some of the most well-known candlestick patterns include the doji, the hammer, the shooting star, and the engulfing pattern. Each of these patterns tells a slightly different story about market sentiment. For example, a doji candle often appears when buyers and sellers are almost equal in strength. The price moves up and down during the time period, but ends up closing near the opening price. This often signals uncertainty in the market. A hammer pattern, on the other hand, may appear after a downward trend and can sometimes suggest that buyers are starting to enter the market again. These patterns are not guarantees. They are simply tools that traders use to increase the probability of making better decisions. The stock market itself is a complex system made up of thousands of companies listed on exchanges around the world. In the United States, some of the most famous stock exchanges include the New York Stock Exchange and the NASDAQ. Large companies such as Apple, Amazon, Microsoft, Nvidia, and Google are traded every single day by millions of investors. Their stock prices move constantly based on supply and